Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night trying to make sense of markets that only seem to like trade news, at least good trade news. And this morning, of course, President Trump and the White House staff were on Twitter, on the wires, promoting how we are very, very close to a trade deal. Now, why would they do that? Well, even President Trump himself said the markets didn't seem to react to the USMCA, but they really react to the China trade deal. So he's kind of figured out before markets open, you get on your phone and you tweet about how we're almost there. And what you see, the computer algorithms, pop stocks up, and they generally trade sideways because the market really doesn't know what's going on, but the computer algorithms seem to love it. But unfortunately, some news changed minutes after market close today. Of course, we haven't gotten a reaction yet, but China now is asking for a removal of the September 15th tariffs on $112 billion of Chinese goods. If I didn't say it was 15%, I think I meant to say that. Before they sign. See, this deal isn't done until it's done, and even when it's done, China doesn't start negotiating until after a deal is signed. Mind you, they never plan on honoring the original deal. But today, one of my favorite leading indicators came out. We're going to look at that, durable goods new orders. But in the end of the day, investors continue to bid stock prices up because they're really hopeful for this trade deal. And it really doesn't make any sense that it's as if the entire world is paralyzed in terms of spending because of a trade war between the U.S. and China. And you get the impression that consumers are just piling up massive mounds of money. They're like, man, I'd go down to Circuit City and get me a new TV, but it's trade war, so I can't do that. Or they're thinking, I'd go down and buy me a new Chevrolet, but I don't want to get caught in the trade war. No, none of that's actually happening. People just don't have any money right now because the Fed tightened monetary policy, so the global economy is slowing. But if you may wave a magic wand and make the trade deal go away, all of a sudden there's just going to be this flood of spending in the economy? I don't think so. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This channel is not to be construed as recommendation or solicitation by selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. See the opinions expressed in the video that I own do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial, and hence why we are going to take a look at durable good new orders here in a little bit. But first, let's check out the liquidity conditions of the market, which turned positive. And of course, as it makes sense, they did, as the market gaps up every morning and trying to make new highs. If we have time, we'll look at that. Even though buyers and sellers really aren't driving the market higher, it's these early morning computer algorithm generated gaps that are happening on very light volume, where they come in and they just slam the market up and let everyone else figure out what to do with it. And even beyond weak economic news, the market is just not going anywhere. No, buyers don't want to buy, sellers don't want to sell. But nevertheless, the NASI is back in positive territory. We're looking for a big sell-off to bring the market back down. But despite being at all-time high, you'd think this thing would be off the charts up here, but it's not. It's telling us liquidity conditions are still very, very tight. Now, when we look at how the hedge fund managers are positioned, courtesy of hedgeopia.com, you can always go there yourself. It's hedgopia.com, and you can look every week at the COT peek into the futures through the futures. So let's see how 10-year treasuries, we've seen the speculators back off their short positions as the longs start to cash in and take delivery of their bonds. Again, they're getting ready for the final move, and you can kind of tell that's going to happen because when there is a shift from short, here's a short, to long, there is a one final move down. So here you can see a small short to long, boom. Why is that? Taking delivery, selling those bonds to the hedge funds. Looking at 30-year, we see they backed off quite a bit too, despite rising yields again. Why would you see yields rising and positions backing off? Because the smart money wants to buy those bonds at the lowest possible, at the lowest possible price they can get, because they want to buy. Now they're ready for the upside. So they've made some money on their futures. Now they want to make some money on the upside. So we see prices, interest rates have gone up, prices have gone down. But these coiling patterns, you see it right here, it starts to kind of coil a little bit when you're going from short to long, means there is still yet one final move. And again, the economic data tells us that for sure. Speculators remain very, very long oil, as if oil is going to go to 100 a barrel. It's not, but they seem to keep betting that it's going to. And as we look to S&P 500 futures, they're slightly long as it breaks out to all-time highs. You would expect them to be way up here, but apparently they're not so bold. Looking at gold, again, very, very long positions in gold. We know that when gold gets overly extended, people get very bullish and price reverses. And it makes sense when we look at the money multiplier, which we haven't done in a while, and someday we need to. Again, NASDAQ 100 breaking new all-time highs as investors, speculators are somewhat bullish, not overly bullish, but somewhat, certainly not like they were back in 2016. And they may remain net short the Russell 2000, which is mostly made up of U.S. companies. So whereas the other major indices have more international exposure, the Russell has more U.S. exposure. Dollar, they remain fairly long the dollar, despite the dollar dipping. I still think the dollar is not done with its move higher, but a lot of people are saying its dollar is done, but I don't think so. And then last but not least, probably the chart to look at is the Vix Futures. And this is now showing a record short position and volatility by the speculators. They have never been more short volatility in history. And when you compress a spring, so think of volatility like a spring, and you compress it and you can hold it. Well, at some point you can't hold it anymore and boom, it springs up. Well, that's volatility. So why do speculators short volatility? Because they're buying stock, shorting volatility, so they get a multiplier effect out of it. The problem is when you get deeply short volatility, people start coming in and buying it, not suggesting that you do, but this is what happens, or they short the market, one of the two. You can do either one. Again, you should not do either one, but people do. And all of a sudden, those short positions start being pushed up against, and you get a short squeeze, and those short sellers are forced to become buyers, and then that get that big springing effect. So a lot of people are saying the market's going to break out here, but when you look at this chart, you would see, well, how is the market going to break out when volatility is sitting at a record short level and is not at its record low? It's just at its record level of short positions. So it tells you volatility is likely to spike and the market is more likely to sell off. Now, what will be the catalyst? I don't know. But that is likely to happen. All right, so while I get these slides loaded for the next thing, let's talk about durable goods, new orders, why I like that, and what it's really telling us here. So what is a durable good? Something that lasts a while, something that you don't buy very frequently, and something that everyone owns. Let's say a refrigerator, washer and dryer. Things that you buy, but don't expect, a year later to have to replace the thing, or 2 years later. You hope to get 5, maybe 10 years out of it, or more, depending on your needs and what you do with it. So what are new orders? Those are new orders coming in for those items. So when you see a demand for, say, washer and dryers, and you see new orders come up, you're thinking, man, there's a lot of people that want to buy these things. That is bullish for the economy. You tend to see that coincide with new home sales, right? Someone buys a new home. Well, somewhere along the line, someone's going to need a washer and dryer, whether they move their old one into the new house. A lot of people like to buy new ones when they buy a new home, or the people buying the old home need to buy a washer and dryer because the old owner took theirs with them. And so this is a really good indicator of the health of the economy. So when you see durable goods, new orders, not just durable goods, but new orders rising, it tells you there is a demand for large consumer goods. Pretty cool, right? And when it's contracting, it tells you there's one of two possibilities. One, it tells you that there's no consumer demand or falling consumer demand. The other thing it could tell you is maybe consumer demand is still good, but there's overproduction. There's too many, say, washer and dryers in inventories at the retailers and wholesalers, the supply chain is just massively backed up because the factory was cranking them out thinking there's going to be a bunch of sales. So if you're a business, let's say we own a washer and dryer business and we manufacture them in durable goods, new order. So we go into our purchase or new order department and say, hey, so what's going on this month? They say, well, orders are down. Ooh. What are we likely to do? Lay people off. And that's why there is a relationship between unemployment levels and payroll hirings to durable goods, new orders. Because if we have a surge of orders come in, what might we do? I said, well, we need to add another shift to the factory or add some overtime, get some more people in here to help out, and we hire. But when it's the other way around, we lay off. So let's take a look at what happened today with durable goods new orders. And they came out on a year-over-year basis down. You can see it in blue. It says minus 5.55% on a year-over-year basis. So that's a pretty big drop. And you can see kind of in the past when you start getting these drops before recessions, it tells you the recession's coming because it's a leading indicator. It's a leading indicator. So that's why I was suspect on the non-farm payroll report last week and why I'm still not convinced that it was accurate, because what the non-farm payroll report is saying on a year-over-year basis, that it's running kind of below trend for the cycle, but it's still creating jobs. Yet in the meantime, orders are falling. You see, something's not making a lot of sense here. Let's take a look at it in terms of unemployment rate, and you can see that when durable goods new orders start to roll over and fall, look what happens. You get unemployment claims, which are shown inverted, start to increase. And you can see it both here before the dot-com bubble. You see durable goods new orders leading this charge down, and you see it here before the great financial crisis. And now we've got a couple months of slowing and contracting durable goods new orders on a year-over-year basis. So it tells you very clearly that it's likely the the unemployment numbers are going to be more of a leading indicator, because non-farm payrolls are a lag. So we should start to see unemployment claims start to rise. Let's take a quick look at the market. I'll show you some of these gap and runs. Here's the S&P 500. Here's a gap open. Again, all these are going to be trade war related tweets or comments coming out of the press. And then market gaps up, goes flat, gap up, goes flat, gap up. And these gaps will get filled. So the gap. There's a gap here, they need to get filled. And with that, we saw Treasury yields up today. I think I mentioned on Friday that this gap down between Wednesday night and Thursday's open would need to get filled. And I said, for all I knew, it was going to get filled Monday morning. And lo and behold, 10-year Treasuries came 1/100th of a percent of filling the gap. 30-year yields filled their gap. And this is something you really want to see. So if you're bullish on Treasury bonds, and I am, the last thing you want to see is a gap here as it moves lower. Why is that? Because here's gap that had to eventually get filled. And you have a gap up here that eventually, on the way down had to get filled. So you want these gaps to get filled if you're bearish on Treasury yields or bullish on Treasury bonds, which I am, rather than have it gap here and keep going down, because it tells you at some points we're going to reverse and come back up here. So there's a 3-year Treasury auction tomorrow, 10-year on Wednesday, and a 30-year on Thursday. And my guess is yields are going to hover around this zone. And I imagine 10 years will fill the gap. 5 years have still got a ways to go. We'll see if they actually fill or not. I imagine at some point they will. But nevertheless, if we go down and look at, say, TLT, a good proxy for the 20-plus year Treasury bond, which it is, or 30-year yield, you can see it's just floating right around its 100-day moving average, and it gapped down. And you can see that gap on 30-year yields here. So there is a gap between the close here and open. And when there is a gap, that means it's going to get filled. So what the market is telling us already, it says, hey, we're just going back here and doing some housekeeping stuff. but we left you a note to say we're coming, we'll be back. And so we have a gap here. This gap was filled. There's a gap up here, and then there's a gap right near the all-time highs. So those gaps will have to be revisited, and we've looked at them. I think we can see them fairly easily. There's a gap here, and now there is one today in here somewhere. Maybe it's there. It is right in there, and then the big one down here. So again, all those gaps need to get filled, and they will soon enough, because the economic data keeps getting worse, and people are still bullish on stocks. Makes me think it's like the dot-com bubble all over again. I'm Steve Van Metre. We'll see you Wednesday. Thanks for watching. Bye now.